Lee, and we're talking about tariffs today, but lo and behold, earnings coming up real quick. Shana Sissel is President and CEO of Banríon Capital Management, joining us from Chicago right now. Stocks are expensive, and I got to wonder, with the earnings season upon us, is E going to justify P?
You never know. It depends on how accurate those E's are in the estimates. We continue to see fairly conservative earnings estimates from the street. And so what has been consistent since the pandemic is that there's always consistently higher than average earning surprises. So I think the wild card here is the continued uncertainty related to the tariffs and how that affects some of the biggest drivers of S&P earnings, those Mag 7 names, because many of them are multinational. But, it's hard to really tell because, we thought it would impact everybody in the previous quarter, and it really didn't. But, when we think about that, it really comes down to the conservative nature of street estimates.
Shana, how political do you think markets are going to get in relation to the Fed, especially in the second half of the year?
Well, they haven't been political as much as one might expect, especially when it comes to pressure on the Fed. I don't expect to see the Fed cut like everybody else does because the economic data simply suggests that even with higher rates, the economy is doing quite well. But again, the tariffs are the uncertainty, and that's also the wild card in the Fed decision. But the politics, I think, have less an effect this time because as it pertains to Chairman Powell, it's a known fact that he's not going to come back for another term. So he's under a lot less political pressure because he's not worried about trying to save his job.
Okay, so what replaces Powell in terms of policy adjustment?
Well, that I don't know the answer to. That's not really something that I've been focused on.
You can guess.
I could guess, but then it would be on the record and people would be able to look at this interview when I'm wrong and be like, see, you were wrong.
Well, they do that with me and Isabel all the time.
Throw something at yeah, I mean, that's the downside of having, receipts for what people say. But yeah, I really haven't spent a lot of time worrying about that. We're really focusing on managing client portfolios for volatility and not really worrying about, what might come after Chairman Powell. So that's like a year from now.
The consensus seems to be in a change from earlier this year in terms of recession calls, that maybe not recession now, but slow down. The idea of no recession, does that mean you definitely got to buy stocks at this point?
I don't necessarily think so. I think volatility is here to stay. And so I'm focusing on ensuring that client portfolios are allocating to things to manage and dampen volatility. And that isn't stocks. But what it does do is kind of take money that would normally be allocated to fixed income and put it into things like alternatives. And that allows us to get potential upside, in case I'm wrong, in equities, because you can take a little more risk in higher payout opportunities. But for me, it's really about managing volatility, because I think the one thing that we know for sure is that with all the uncertainty and the tariffs, the way that this administration goes about its business, it just essentially sets us up for higher volatility being part of what this market is going to be for the foreseeable future.
How do you volatility proof your portfolios? Because you're focused on that, and we're really seeing a lot of that. It seems like there's no slowing down when it comes to headlines and market gyrations. What does that look like for you?
So for us, that's using alternative investment products. And the good news is, for the average investor, there's plenty of opportunity. This year alone, the vast majority of new ETF launches have been in the alternative space, whether it be creative buffers, lots and lots of creative crypto ETFs, long, short. Many of our largest ETF issuers like iShares and Fidelity are launching alternative products like the Bridgewater product and the private credit product that State Street has. Fidelity just launched a managed futures product. I think that tells us that our largest asset managers are out there understanding that the demand is there for products that have low correlations to traditional equity and fixed income. And so that's how I'm looking at it. So I'm looking at products that have low correlations And that is going to dampen volatility and help manage risk in client portfolios in a period of time where there's a lot of uncertainty and an increase in average market volatility as a result.
Can you say specifically what it is you like for your clients? Give me some specific examples.
Absolutely. So we manage a core alternative ETF model. And so some of the things that we really like right now are long short equity. So something like CBLS, which is a cloud hedged equity strategy. It's an active long short product. BTAL, which is an equity market neutral fund, which, in full disclosure, can be quite volatile in and of itself, but it does well when volatility is high. When you take another look at things like managed futures, so like a CTA, or I even like some of the Bitcoin type of strategies like a BEGS, which is Bitcoin and gold and silver and other precious metals, where it's more tactical. So those are the kind of things that I'm looking at, things that are really not equity or fixed income per se, and that are managing downside risk. But also with like a CBLS, that gives me the potential to benefit from good stock picking. As equities are more of a stock picker's market, we've seen active management do better than passive management.
How much of the U.S. rally is really just about tech over concentration? We have, again, the biggest stocks comprising 40% of the market. That's a new high, versus growth prospects, like actual growth in the second half of the year.
I think a lot of it is driven by that. In fact, if you looked at some of the stock picks I sent over to you guys, it's heavy in the tech sector. I'm on the record for years now as being a massive NVIDIA bull. And I think that long-term trends, particularly as it relates to AI, are driving that and overcoming a lot of other negative news as it pertains to the tech sector and tariffs and any sort of export controls. So that, I think, is driving the market. If you look underneath into the individual stocks that are driving the returns of the market in this rally, it is mostly tech names. And so it is not necessarily growth that is helping this market move forward. It is really longer term trends where people are trying to take advantage by looking at the winners of something that will pay off, say, 5-6 years from now. And the growth in the US has been quite muted, but it has been stable. So that's kind of the conundrum we find ourselves in. That's the conundrum that the Fed finds itself in, is that the growth is there. It's not particularly strong. It is being driven by, concentration in certain sectors, but the concentration is actually a tailwind as a result of this AI trend, less so than just, people having FOMO.
Shana, always a pleasure. Appreciate it. Thanks for showing up today. Shana Sissel,